everyone, Sarah here. Welcome back to the channel. I am your 7-figure real estate investing coach, and I'm so glad that you joined me today because I'm going to be covering something amazing. It is a strategy that I love. It is a strategy that has got me to 7 figures in my real estate portfolio and will likely get me to 8 and beyond. And it's the strategy that I really highly encourage a lot of my clients and coaching clients to use when they're first getting started. It really allows you to rapidly scale, probably faster than any strategy I know, while holding properties. You can grow really fast while flipping, but this is the type of buy and hold strategy that can really get you to accelerated growth and really like net wealth really, really fast. You can get onto bigger and better projects if that's what you are looking for. So really excited. Like I said, I really love sharing my story about these types of strategies because it shows you that any real person can do this. This was one of the first types of strategies I used. It was pretty foolproof once I knew how to do the numbers and the formulas. It is not rocket science. And yeah, it's really cool to show you that 2 years ago, I had no properties. Now I have 7 figures just because of the strategy alone and a little bit of training and mentoring. So this is definitely a strategy for everyone. Let me grab my marker. All right. So we're going to do and cover something called the buy, renovate, rent, and refinance strategy. This was much harder to write than I expected. Otherwise known in the industry as a BRRRR. So if you ever hear a real estate investor say BRRRR, it's not because they're cold. They're actually talking about this strategy: buy, renovate, rent, and refinance. So this is a really cool way of scaling because it allows you to buy something that's slightly undervalued, that has a little bit of work that needs to get done, rent it out to a tenant, refinance to pull out your initial investment, and then carry over that investment into another property. I know this sounds so simple, but let that sink in for a second. Can you imagine that instead of sticking all of your capital in one property where it has to sit and appreciate for years and years and years, you can actually use a strategy to keep recycling that initial investment again and again and again. This is massive because yes, one day you're going to run out of capital. You're going to run out of mortgage financing capability. But you probably know friends, family, joint venture partners that have more capital, that have financing. And that means that there's unlimited resources, unlimited amounts of houses that you can buy using this strategy. And I'm sure they'll love it too. Instead of being capped out, they get to just continue to utilize this strategy. So I'm going to show you an example to show you how this actually works. So you're going to buy a house. We're going to keep numbers simple. I realize that in the GTA especially, finding numbers like this probably aren't realistic, but it'll just help you get an idea. So say you buy a house for $100,000. Now, you found the house, it's a little run down, it's probably a wholesale deal, maybe there's a hoarder or someone going, distressed seller. And say you are able to buy this for cash. If you're like me, I use my BRRRRs using hard money and private financing. So I use my investors' money. I got a mortgage, a private mortgage, and bought this house for cash. Now the house needs about $20,000 in renos, and I'm going to estimate, let's say, $15,000 for lenders' fees, holding costs, etc. So keep in mind that when you do a flip, or this is kind of like doing a flip, you have to take into consideration that there's a cost to this private capital. There's a mortgage, right? There's taxes, there's water and hydro, there's holding costs. Maybe this lender charged you a lending fee. There is a cost to refinancing through a mortgage broker. That's going to encapsulate all of those, land transfer tax, all of those little accrued expenses. So this brings us to a total capital investment of $135,000. Not too bad. Now, you go to the bank, you get an appraisal done. The appraisal comes back at 180. All right, now we're doing okay. Now here's the thing to consider. This 180 is not subtracted from that because the bank is not giving you 100% loan to value like your private lender is giving you. They're going to give you a traditional 80% loan to value. You have to keep 20% in the property. They want you to have collateral. They want you to have skin in the game. Sometimes if you have a lot of properties, they might only loan you 65 or 70, 75% LTV. So you need to shop around and make sure you have a really good mortgage broker before you go to do this whole refinance process. Someone that's experienced with investments. So you're not going to take this number. You're going to take this times 80% LTV, which is going to give you $144,000. So this is the number of a mortgage that the bank is actually going to give you. But because we force so much appreciation, that's okay. So do the math. If we do 144,000 less, all of our lender's fees, the cost to refinance, legal fees, and the $20,000 run out, now we're left over actually $9,000. So this is how this works. You bought this house for cash, right? With a private mortgage or someone else's money. You put in $20,000 in renos, which probably had fees associated with it if it's hard money. Have about $15,000 in terms of lender's fees, holding costs, different capital expenditures. We put in $135 capital in, right? It appraised for $180. The bank gave us an 80% loan to value mortgage on that property, which is $144, which allowed us to cash out the original investment, cash out all of the expenses we put in the renos and whatever. We're still left with $9,000. That $9,000 isn't evaporating into nowhere. That's a profit. So not only did you get all of this money back to recycle into another property, this reno and capital expenditure costs, you also made a little pocket money on the side too that you're going to have to pay taxes on through capital gains, but that's okay. You made $9,000 probably in 3 to 4 months. Plus, you get an amazing property that's probably cash flowing. Because, let's say, you're making $900 a month in rent, plus the tenant's paying utilities. With a mortgage of, $144, you're probably paying, $700 a month for a mortgage, maybe even less. You're probably paying maybe $600 in mortgage plus some other costs, your insurance, taxes, things like that. You're probably not doing too bad on this property. Even if you're only cash flowing $100 a month, you still bought it for absolutely no money down. This was none of your own capital. This was hard money. This is private lender's money. And you even made a little profit off of it. Isn't that phenomenal? And this happens with properties much, much more expensive than this. I do this with $500,000 single family homes that we duplex conversions on. So we use hard money, we use mortgages, we use private mortgages, we use a lot of different sources, and we're still able to force appreciation through the renovation, rent it out, increase the value, and then refinance, cash out all of our money partners' capital, keep the property for ourselves, and then recycle their money right away into another project. By doing that, we are not limiting ourselves at all. We are just the sky is the limit when it comes to BRRRs or BRRRs. The thing to keep in mind are some of these caveats. The fact that, yes, the bank will only give you 80% LTV. You need to make sure that you account for that. This is not your total profit cost. This is the appraised value, but the bank is only going to give you 80% LTV, and make sure that you find a bank that will give you the full 80%. Also, you need to keep in mind that there are fees associated with all of this. Probably most important of all is to remember that after you refinance, you need to make sure that your property still cash flows. At this $100,000 mark, you're cash flowing quite nicely. But as your mortgage payment increases and your cost of keeping the property increases, make sure that you do a pre-reno cash flow analysis and a post-reno cash flow analysis, because we never want to get into that situation where you're now in a negative cash flow situation. If that's the case, you have two options. You can try to negotiate the price down a little to give yourself more buffer, or you actually might need to just walk away from that deal. Remember, I never advocate negative cash flowing properties ever. Even if you're going to walk away with a $9,000 profit, that's not going to help your pocket over the long run if you're constantly in the negative and having to pay out of pocket. This is just going to cancel itself out. So those are the small downsides, or the things that I want to caution you about when you're doing BRRRs. This is not all fun and games. It's not just super simple. The refinance process can get very complicated, especially if you're in Ontario. You'll know how tight the lending regulations have gotten and how tough they're making it for us to refinance now. So make sure you go in with your eyes wide open, that you've met with your mortgage broker before you go ahead with this, knowing that you can qualify for that new refinanced amount, that your property is going to cash flow, that you have all of your ducks in a row. But done correctly, you can see the power of this. It's like a flip and a hold in one, and you get to continue to recycle that initial capital again and again. You can see how fast you can be able to scale if you're using other people's money to do this, especially, which is really cool. If you're doing this with your own capital, it's also super powerful. Rather than having that rental budget stuck in a property, you get to take it out and do it again until you hit a financing wall. Then, you can pull on some partners to help you hold some mortgages. So I hope this is really helpful for you guys. Again, BRRRRs are the bomb. They're my favorite strategy. It's how I have gained 7 figures in my portfolio rapidly in about 2 years. So, and if I can do it, you guys can totally follow this model and do it too. So thanks so much, guys, for tuning in. Again, please remember to subscribe if you like the info and you want to keep getting awesome free real estate investing content. I love providing it for you guys. And by subscribing, you're really helping me by keeping the momentum going, and so I can share all of this stuff with the rest of the world. It's something I'm really, really passionate about. So until next time, guys, stay tuned. I'll be posting a new video every single week. See you next time. Hey guys, thanks so much for tuning into my channel. I really hope that you enjoyed today's video. If you're looking for even more amazing content on real estate investing, make sure to hit that subscribe button. I'm going to be releasing amazing videos every single week, so you won't want to miss it. If you want to learn more about working with me and what I do, make sure to check out my website as well. Bye guys.